Hi class, I'm so sorry I can't meet with you today to go over statement of cash flows, but I think this video will be helpful to you. This video should be a nice refreshing change from doing standard costs and all that kind of stuff, where we switch gears once again to financial accounting. The statement of cash flows is one of the several basic financial statements, which include the balance sheet, the income statement, the statement of retained earnings, and in some cases the statement of changes in comprehensive income. And here we are, statement of cash flows. In this chapter, we'll be revisiting some of the rules that we have learned in financial accounting, which is in our previous course. So don't forget about your financial accounting, it's still relevant. In this chapter, we will talk about cash flows. Cash flows is money. It's green money. It's money is cash and cash equivalents that organizations either receive as an inflow or pay out as an outflow. So we're going to talk about those cash flows, and we're going to talk about how they are categorized in these three different areas: operating, investing, and financing. We're going to go over how to prepare one, not only using the indirect method, but also the direct method and what it all means. So cash flows. First of all, we want to know cash is money coming in, and we're talking about cash and cash equivalents. Cash and cash equivalents meaning currency, money in checking accounts, money market accounts, also short-term treasuries. These are things that can be converted to cash relatively quickly, and they're intended to be converted to cash relatively quickly. So that's basically what we're looking at. We want to see the increase or decrease in cash over a period of time. We want to know how an organization uses cash during the period, and we want to also help others, external users particularly, how the organization uses its money and how it generates cash, and see if there's any inability or ability to meet their financial obligations in the future. So we need to make sure that we have enough cash. Being profitable is very, very important, and that's what is shown on the income statement, but being liquid is even more important, and more organizations are actually concerned about that. So here is the basic statement of the statement of cash flows, the operating activities, investing, and financing sections. I think when we read this chapter, it's very important to know what type of transactions are relevant to each one of these different sections. And they're not too difficult, but you really have to read through the chapter, and I'll be quizzing you on little techniques that you can learn that will help you. The operating section is going to be important because it's all about profitability. As I mentioned, cash and cash equivalents is all we care about. That includes obviously coins and nickels and dimes, but it also is checking and savings account, money market accounts, etc., and highly liquid accounts. So when you talk about cash and cash equivalents, don't just think about the checking account. You got to include all cash, including petty cash. So when we talk about how an organization uses money for their operating activities, you have to think about the income statement. The income statement is going to be the key, right? To be completely honest, it's going to be the key to helping you prepare that section, whether it be on the indirect method or the direct method. Investing is all about long-lived assets, PP&E. Anything that's happening about your PP&E cash-wise, you're going to be included in that section. And then also finance is going to be stock and the long-term liabilities, which is like bonds and other types of liabilities. So when we talk about operating activities, we talk about day-to-day transactions that have everything to do with profit, how we generate profit, whether we have a loss or not. It's not really the point, but the main point is if it's generating profit, we want to consider it. And in this case, it looks like to me this is going to be the direct method because it's categorizing these different activities. You'll see a difference when you look at the indirect method. And then we go back a page and see. Yeah, the indirect method basically is going to be converting your net income to and removing all of the non-cash transactions from net income to arrive at your activities in operating section. Your investing activities, obviously PP&E, long-term loans, cash receipt. And again, if you purchase a long-lived asset and you did it with a debt instrument, it's not going to be shown. It's going to be largely ignored on the statement of cash flows. And that's very important. We do not care about non-cash transactions. Only inflow of money or outflow of money is only going to be shown on the statement of cash flows. And my advice with these slides is to remember or try to memorize the type of transactions you should expect to see in these three sections. That's going to be really critical because a lot of times students get concern is like, well, should it go in this section? Should it go in that section? These 3 slides really are going to be basic, and they are absolutely going to be important for you to be able to pick out the really, really common types of transactions you'll see in each one of these sections. So interest income and dividend income. Now, when you're creating this statement of cash flow, you're thinking about interest income and dividend income, and they're going to be operating activity type of things, clearly. When you have interest expense, you're talking about some type of debt that you have, and you're paying the price for, getting that debt. So it's important to note that when you have interest expense or some kind of dividend income from an organization that you have a part ownership in, it's going to be shown in it's going to be shown in the operating section of the statement of cash flow. Now, when you pay out dividends, however, payment means your organization is paying to its shareholders, and you may very well be one of them. That's going to be a financing section item. Not only the common stock that they purchase from you, but also the dividends that you pay out to your shareholders are going to be shown in the financing section of the income of the statement of cash flows. So my thing, I think, with this chapter is, why do we prepare a statement of cash flows? Which you'll need to know how is the information presented on a statement of cash flows, the 3 sections, how to categorize the various transactions and put them in the right bucket, if you will, and what type of things this particular statement gives you, the advantages and disadvantages of a statement of cash flow. And I think, and then finally, obviously, how to prepare a statement of cash flow using the 2 methods, the direct method, the indirect method. So non-cash activities, we don't care about anything that's not going to hit cash. And that's really what I think you will not have too hard a problem figuring out. We care only about inflows of cash. So the operating activity section of the statement of cash flows can be presented in 2 different ways, a direct method or an indirect method. And we saw the direct method really closely because we saw the different categories of the cash receipts or the cash inflows of the organization and some of the outflows. We saw the categories, as you can see here. The indirect method is basically converting the accrual basis net income to a cash basis. That's all it does. And doing that, you have to strip out the non-cash transactions. And we're going to go over how to do that. So it's all about this one statement giving users the impression of how liquid the organization is and how well or poorly they are able to meet their obligations, their financial obligations in the current as well as over time. So preparing the statement of cash flows is not necessarily difficult. I think the really important part, especially when you're learning, is knowing which transaction fits in the various sections of that cash flow statement. That, I think, is more important than anything. You really need to know how to categorize these transactions. So if you're doing things from the net income section or you're doing it from the indirect method, the operating section, what type of transactions are particularly important and should be shown in that section. And I can give you examples. Any transactions that have anything to do with the profitability. If it's an income statement item, chances are it's going to be shown in the operating section. If it's some type of cash inflow or outflow due to customers, etc., if you generate a profit, the transactions that led you to that transaction or that bottom line is going to be shown in the operating section. And particularly, I think it's most important is when you're using the indirect method, you will be using the net income as your starting point in preparing that section. Now, it's important to also note that the statement of cash flows does not show any difference in the investing or the financing section, regardless of if you use the indirect method or the direct method. The direct method or indirect method really only affects the operating section, and that's very, very important to note. The other 2 sections are exactly the same. So here's the income statement, and again, this statement is going to be used when you're trying to complete the statement of cash flows using the indirect method. You're going to start right at that 937,300, and you're going to back out, add, subtract. For example, this 937,300, if you think about it, there are some very, very obvious non-cash transactions that you will know off the bat that you need to remove. And one is going to be the depreciation or amortization or depletion, either one of the 3. Those transactions have no cash at all. in those. And so if depreciation is going to be a deduction in net income, you'll have to add that back to the net income. And you're going to see this actually makes a lot of sense. This is actually more intuitive, which does explain why many people, many organizations use the indirect method for preparing their statement of cash flows as opposed to the direct method. But for GAAP purposes, either one can be used. Both are acceptable. Using the comparative balance sheet, this particular financial statement is kind of important because when you're trying to group or categorize the changes in these particular accounts using the indirect method, it becomes very, very important to know a comparative, using the comparative balance sheet, because any change in accounts receivable, which is a current asset, has a specific type of way of being handled on the statement of cash flows indirect method. So using the comparative balance sheet is going to be useful, particularly when you're actually going to be preparing the statement of cash flows using the indirect method. The income statement quite helpful as well, and that will be helpful when you're preparing the statement of cash flows operating section using the direct method. So again, it all makes sense as you start to prepare them, and we'll do some practice problems, and that'll be very, very helpful for you. So if you're preparing the statement of cash flows in the operating section, remember, when you're using the indirect method to prepare it, it's going to always start with net income. And then you're going to be adjusting, adding back to your net income, subtracting from net income to arrive at your cash used or cash used in operating activities. Adjustments include non-cash expenses and revenues, and this is, again, has everything to do with gains and losses, has to do with depreciation, amortization, and depletion, all those types of things. So changes in current assets, you're going to have to see how do we back those items out? How do we back those liabilities out, particularly the current liabilities? And again, when we talk about profitability, net income, you're going to be dealing with a lot of current in these transactions, current liabilities and current assets. Long-term liabilities and long-term assets most certainly will be reflected, but not in this section. So non-cash transactions. Again, this is just giving you an idea from the indirect method perspective. If depreciation is deducted to arrive at the $937,300, we'll have to add it back. And the opposite would be true if it's a gain. A gain is going to be making that number get bigger. So to correct the non-cash side of the gain, you have to subtract it. And again, it does actually make sense. This particular slide is kind of important because it gives you a snapshot. If your current asset is going up, it's going to be a reduction in your net income. If your current asset is going down, it's going to be added to their net income. Very, very good rule of thumb. And if we go through the chapter, you're going to see it actually makes a little bit of sense, this way of doing things. And this is all assuming the indirect method is used for preparing the operating section of the statement of cash flows. So understand that relationship. It doesn't matter what kind of current asset it is. If it's a current asset and if it's going up, you got to deal with it in a certain way, period. And if it's a long-term current liability, it has to be handled in a certain way, assuming the indirect method is used, period. So using this particular little slide as a cheat sheet is extremely helpful, I think, in helping you. And again, this is the opposite side of the coin, the current liabilities. If a current liabilities go down, you're going to have to subtract from net income. If a current liability goes up, you're going to have to add that change to net income. Again, with the asset side of it, it's a inverse relationship. With the liability side, current liability side, it is a direct relationship. So they go in the same direction on the liability side, and that's a little bit easier for most students to get. It's usually the asset side gets a little bit tricky for them. The major point that I want to make here is this particular example is just giving you very, very succinctly some of the type of transactions that you would see as reconciling items on the statement of cash flow using the indirect method. If you use this as a guide, you should not have a problem at all creating the operating section of the statement of cash flows. Why? Because every single category that's listed here are almost always used in preparing the statement of cash flows every single time. So if you see a gain being subtracted, and in your problem that you're looking at in your classwork, a gain is there, you know, if I'm using the indirect method, I'm going to be subtracting that. period. I don't have to think about it. So this is another slide that I think is very helpful and should be used by you to as a guide sheet, step-by-step instructions on how to prepare the statement of cash flow operating section. So the investing section is not too difficult. The main thing that I want to make clear is you have to make certain that you are only dealing with long-lived assets that have a lifespan that's longer than a year. And that's all we care about. But we also care about cash. If we purchase an asset, a long-lived asset, and part of that purchase was in cash and part of it was in debt, guess what we're going to show on our statement of cash flow? Only the cash portion of that sale. Very, very important to note. We're not going to show all of it. We're just going to show the portion that have a cash effect. And that's important. The investing section, again, the only thing that I think in this section that confuses students is the dividends. If you are an organization paying dividends to your shareholders, it's going to be reported in this section. If you are receiving dividends because you are a part owner of an organization and you're receiving dividend income, that will most certainly be an operating activity item on the statement of cash flows. Know those two differences because they're commonly an error that students make when they're preparing the statement of cash flows. So look for changes in equity account. Look for changes in long-lived, long-term liabilities. Look for changes in retained earnings. Changes in retained earnings is going to tell you dividends have been paid or something like that. Very, very important. And using the balance sheet comparative will be an important piece to help you make that determination. But I would say of all the three sections of this statement of cash flow, I think this section, the financing section, is probably the most intuitive and the easiest to prepare. Just giving you the heads up as you are going to be preparing the statement of cash flows. So again, long-lived liabilities, long-term, 30-year bonds, anything over a year, if it has a cash effect, you're going to be reporting it in the financing section. Now, this is a complete look at the statement of cash flows using the indirect method. I would suggest printing this particular section out of the PowerPoint presentation and use it as you're going through these questions, particularly those that are multiple choice. I mean, preparing the actual statement of cash flow may not be necessarily difficult. What challenge students often face is the actual multiple choice questions because they're asking you a very specific type of question. They ask you to calculate a specific number that you would normally see on a statement of cash flow. So it's kind of important to have this little guide sheet to help you. And again, free cash flow, this is just more analysis, what's left over to use either to invest into something else and have money work for you. Again, excess cash an organization holds and it's not being used is waste. And if you have excess cash as a result of your efficient use of your cash flow, you need to be able to make certain that money is working for you. And that's using it for investment purposes. Investing meaning CDs, short-term treasuries. Earn something for that money that you're not quite using or not ready to use yet. So here are the steps that I think that most students will be helpful to you. What I'm going to do with this particular chapter is demonstrate a complete preparation of a statement of cash flows using both the direct method and the indirect method. Your job this weekend will be to read the chapter thoroughly and be prepared for questions that we will be going over in class with your classwork activity, but also in the class with our live lessons. So these five steps are very, very good. But I think more than anything is printing out the slides that I have identified because they are far more effective in allowing you to efficiently use your time, not only preparing the statement of cash flows itself, but also answering questions that are in multiple choice format. So how to prepare it. Now, the major thing is when you're using the direct method, you're going to be looking at the statement. You're going to look at the balance sheet, but you're going to be looking at the statement of income because it's going to really be helpful if you identifying the type of transactions that have occurred. And we're talking about grouping of activities, receiving cash receipts from your customers, very, very large, major categories, purchase of inventory if you're a merchandiser or you're a manufacturer, payments to employees, payment for utilities. Those kinds of costs are easily identified within the financial statements. and then determining cash payments. Sometimes you'll have to analyze current assets and liability accounts in relationship to one another, because one account affects the other, which in part you have to dissect or reconcile the transactions such that you can identify what cash came in and what cash went out. And why do I say that? Is because sometimes when you see the change in your current liabilities or you see a change in your current assets, it's not easily identifiable what the cash effect of those changes are. And sometimes having to do a little bit more analysis and a little bit more drilling down to determine how to calculate cash received from customers, because it's not necessarily evident. And there are some ways that we will be doing those type of analysis. One is going to be cash receipts from customers. How do we calculate? If we know what certain account balances are and how they're related to one another, we can deduce with this example in front of you what the cash collections from accounts receivable is. And again, these are very, very important computations, because sometimes it's not evident. It's not easy to pick out just by looking at it what the amount of money that went out the door when paying for inventory or paying to your employees, that sort of thing. So looking at your accrued wages is important. Looking at the change in accrued wages could be a very helpful way to back into what you actually paid to your employees. And again, this is another, I guess, another slide that I think will be very, very helpful to you. And it's really helpful when you're talking about answering a question in a multiple choice format. They're asking you how much was cash paid for inventory. Well, they're going to give you some information, and your job would be to go back and say, okay, what's the relationship between inventory and something else, and what happens if one of those accounts go down? What effect does it have? What does it deduce? What does it lead me to believe in terms of cash paid out for inventory? Cost of goods sold is one of those items that you have to analyze and consider, because its relationship between a payable and cash and inventory could deduce or allow you to deduce what you paid in cash. And same thing here, using cash payments for wages is another way to back into it by just analyzing the wage payable account. When you see your liability for wages go down, you have to say, I don't owe that money to my employees. There's a good chance that we may have paid cash. Let's analyze this account. And again, that's just another account that have a relationship to wages, have a relationship to cash being paid out. You can somewhat deduce how much you paid in cash to your employees when that number is not easily or immediately given to you, or looking at the balance sheet is not obvious to you. You can still use the information to back into it, because we know that there's a relationship between cash and your current liability called salaries and wages payable. Because you know that when you don't have a liability anymore for paying for wages, and your cash goes down by the same amount, you can deduce that liability went down because you paid out cash to your employees. And again, these are just standard analysis that show relationship among accounts that will help you to create the categories with the correct amount of money that went in and went out for cash flow, for determining cash flow for operating activities. So analyzing your current asset and liabilities will allow you to be able to look at and determine the cash that was used or cash that was received for various transactions for operating activities. You also will be doing this same type of analysis when you're doing the indirect method. And it's very important to note that these analyses are just not useless. They are actually a good way for you to see how these accounts are interrelated with one another and how they are useful in making certain assessments. As one account goes up, the other account generally will go down, and almost in the same amount in proportion. There's an indirect relationship, or in some cases a direct relationship, and knowing that is quite important. You doing the indirect method, you're talking from the converting the accrual-based net income to operating activities. The direct method does allow you to group different categories of activities typical of an organization's profit and loss statement. So that's important to note. What I would suggest for you as a student is select the slides that I have mentioned print them out and use them as a guide to help you through. As you're looking at the cash flow statement, remember the purpose of the statement, remember the sections that are relevant to that statement, remember how the statement can be prepared, that's direct method and indirect method, and how to observe the difference between the two, using the relationships among current and assets and current liabilities, and how to back into cash paid and cash received on operating activities, and knowing the differences of transactions that appear in the three sections, particularly operating, investing, and financing, and knowing which transactions are relevant to each, knowing fundamentally that we are only concerned with cash inflows and outflows of cash. Cash in this case is going to include currency, monies in your checking account, and equivalent cash, which includes money market accounts, treasuries, anything that can be easily converted to known cash. I know this presentation was very quick, but I think your chapter 13 is probably one of the easier chapters, and I'm hoping that you find it easy as well. Thank you very much for your time, and I will talk to you in the next video.